Today's number, guys, is 22, as that's the percentage of time markets are up when it comes to what we saw last week and hitting the most traded zone. And it has dramatic implications for whether you're a trader or investor right now. But maybe more importantly than any of this, we've started to see signs of illiquidity when it comes to markets. Bitcoin hit the daily 20 moving average as we suspected, and now it's liquidating massive longs. So, what's next in store for this market? And maybe more importantly, the bonds of the world. Yes, the Japanese yield started to spike again big time. And of course, silver has just gone absolutely crazy. Some of our favorite investments of 2025 are doing well, but others are starting to look a little bit shaky. Go through it together right now as we look at stocks, commodities, and cryptos. See you in a moment. Well, welcome back, everyone, to The Daily Show. This is our special weekend edition. My name's Thomas Atkinson, and in today's video, we'll be taking a look at the macro, what Wall Street is up to, and of course, some of those big options flows, because boy, oh boy, have they been wild. It was a good week for buying the dip, as we suspected, hitting confluence points, but in today's video, we'll take a look at the macro side, we'll look at the big structural levels, the options, and then, of course, the key zones that we're watching right now, and whether Wall Street has something sneaky in store for us. First up, infrastructure. Everyone's talking about the AI bubble. Everyone's talking about data centers. And there's this thing here from JP Morgan and Markets and Mayhem over on X. And basically it shows that GPUs and AI data centers are being used versus the fiber optic cable argument, which was only 7% during the early 2000s. Now, I think it's important to note that this is a little bit different because, of course, the AI revolution as we see it right now, we already have the hardware to be able to often use the actual GPUs, being the computers and other things that we access this software with. But in the future, will it actually translate into dollars? The big question here is, where are we heading in terms of who is going to pay for this? And obviously that's why you see all those memes lying around. And often there's a bit of truth in those memes, because have a look here at the AI compute concept and where the planned usage is going to go. Wow. Do you really think we're going to get to any of these numbers? That's the question of the day. Let me know in the comments down below. Meta is planning this much consumption per year in power. This is going to be absolutely wild if we ever do get near any of these things. And obviously, it's very unlikely that infrastructure can keep up with what's going on here. But this is the question, and at least if I was answering it right now, and I'm sure many of you out there, it's, are we in a bubble? Yes, most likely. Is there more money to be made potentially before we hit the top? Well, there generally is, but the key is always following the structure, the flows, and of course what we do here, which is bringing together the levels of confluence. Now, we do know that this market is basically being held up by large tech sector caps. And really, the real economy, that is the rest of the companies, are not spending that much money, while the big tech is going wild trying to become the number one in the AI revolution. And we do know that whoever becomes in the kind of top 2, 3 of this particular thing will be a huge winner in the future. But once that spend or the questions of whether there's profit on the horizon start to come up from Wall Street, because remember, guys, Wall Street looks years ahead. They're not really looking at today's earnings. They're looking at what they think and they're projecting for the future. That is going to be a problem. Speaking of problems, we do have some macro side issues. China's PMIs are currently out and it's not looking too good. And a lot of you might say, well, see, told you, Tom, it's no good in China. But as I've argued for a long time, central bank liquidity is the key to the China trade. And we've been going for this for now over a year and a half, and it's been very good. And in general, it's been basically supported by central bank liquidity and policy. Now, that's not having as much an effect as people would want onto the economy. So, of course, it may mean that we have some kind of announcement coming out soon that then encourages people to buy stuff. And I found it interesting as well that certain metals are going really well right now. The backbone of industrial kind of the industrial kind of build outs, copper, is going wild right now. Speaking of global financial asset bubbles, just to put things in perspective, if you look at the asset bubble right now of Nvidia, it's obviously really big in comparison to the others. Now, this is not the be all and end all, but it just shows you that generally each one is bigger than the last one when it comes to these markets. And it's important to note that. Let's now get into the data surrounding what really has been happening. We suggested and thought last week that we were going to have a really good Friday. We certainly did. Breadth was all across the board, and a very interesting breadth read did happen. But only 21% of the time after reads such as this, thanks to Blue Kurtic, will we actually see a positive Monday? So it doesn't mean it's impossible, but because we hit the most traded zone, which we'll look at on the S&P soon, and of course, because we had such a great run into the end of Thanksgiving, and I hope you had a good one with your family and friends there, we actually only have 21% chance that Monday's green. And so far, that's kind of coming true with at least the futures. 50% chance that Tuesday is going to be good, and then a 35% chance that Wednesday is going to be good, with Thursday and Friday this week becoming the stronger weeks. So could we have a bit of a pullback into a bit of a rally? At least that's what the data kind of suggests. So let's see if we can back that up with a few other things. One here from Market Stats I thought was good was that the VIX fell a huge amount of percentage. Now, you really do need to think of the VIX less as a number and more as a percentage movement. And over the last 5 days, it got crushed as, of course, the markets went up and found that normal buy the dip or BTFD style dip. And then we also saw the VIX, of course, get crushed from a 28 all the way down. Now, when this happens, it actually brings on, as you guessed it, a couple of days of up, down, and all around. And this is starting to kind of, back up some of that data stat that we find there from the Thanksgiving read. Another one is here from Subaru Trade, which shows that the equity put call ratio, so that is that all of a sudden there are tons of calls in the market and less puts. Yes, it happened just like that. Basically leads into not very good returns about a week later, funnily enough. So what it's kind of showing us is as we hit that key technical zone, we're finding the most traded zone. We're also seeing, calls come out everywhere because leverage is everywhere, guys, at the moment. And debt, I actually spoke about this in my private macro show I do. Links in the description, fairfaxevolution.com, Black Friday sale on for a few more hours yet if you want to join us. And I discussed the idea of leverage acceleration because what's happening at the moment is we are seeing so much leverage being piled into each one of these dips, and it's creating a lot more volatility. And it's why we think next year is going to be extremely volatile with ups and downs. And this year wasn't that volatile. It was at the start. We suspected there was going to be a 10% plus pull down. We suspected it would rally. It did that. It was a little bit more pull down than I thought, though. And then, of course, it's been incredibly strong. But now we're starting to see volatility. So this is very interesting. Now, is it all doom and gloom? Not really. The good news is that we had so many months up in a row. And you can see here, Subaru again has come out and actually found that if you have 7 months up in a row, that's pretty strong. And it does tend to lead into further strength in the markets into the future. So while we might have temporary weakness around this December period, strength tends to come through. Another one here from Next Gen News is really good, which is, of course, the percent returns following the S&P 500 having a 50-day low, then having a massive breadth increase. And if you were following last week, you would have noticed that we got close to hitting several massive breadth reads. And although we didn't hit the big ones, we did get some good little ones. And this tends to lead into pretty strong structural zones, especially over the next kind of 3 months. And this leads in a lot with what we've been talking about with that strength equals strength, at least at the beginning, after having such an epic run. But volatility still remains a problem. And we can explain that really by having a look at what sectors Wall Street has been focused on. Over the last month, gold is now the best returning sector. We love gold. We love gold and silver, guys. Palladium and platinum also looking really good. Then we have healthcare, which of course is a defensive. Oil services, which is totally different to what we've been seeing recently. And look at tech and semiconductors. It's a clear rotation from the street as the story into AI data centers became the number one thing everyone was talking about. All of a sudden, we see different sectors, more defensives, starting to play through. And another one we've seen recently, XLP and even utilities the last 2 to 3 sessions has been picking up. So clearly there's a defensive air in the markets as we head into the end of the year. But it's not all bad because as you can see here from the Almanac Trader, basically we have a sideways normality here to market. So usually the beginning of December brings a bit of vol. Usually it's kind of up, down, all around, structures up, runs into what we call the Santa rally. Now, do you guys think we'll have a Santa rally this year? Let me know because, of course, this is the traditional way that the markets usually move. And we are kind of leading that way. Every time we see a sell-off, guess what happens? We get a buy the dip. We get a sell-off that's somewhere around 1-2%. All of a sudden, we get a rally 5 days later. So basically, the gains have been pretty significant. Another one here from Almanac Trader is that the first day of December does tend to be quite weak. Again, that leans in and lines up with what we've seen with a very strong last week leading into a public holiday. And as you guys know, in the US, it comes down to public holiday weeks are pretty bullish. Some other good reads for markets in terms of thrust. Obviously, we got here a MACD buy signal cross. Here, it usually shows that generally markets do tend to be more bullish after this. Although I will state that whenever you kind of see these reads, it's not good enough to just go out and buy on a MACD cross signal. It's, once you understand what a MACD signal really is, you just looking at moving average crosses, it's not going to be the best read. It's just one of those ones that you could easily put into an algorithm and it's good, but don't read too much into it. It's just a nice little thrust. Now, of course, all these markets are connected, guys. And if it's your first time here, you may not be aware, but you've got to look at crypto now. You've got to look at bonds. We will be soon. You've got to look at, of course, stocks and gold and metals and everything. That's the beautiful thing about markets. But I guess from market structure, if we have a look here at Bitcoin after halvings, one of the things that's happening right now is this clear fight between, is this the end of the cycle halving and the beginning of the end for like this Bitcoin, we go into the Bitcoin winter, or will we see a rally? So what's happened so far is we got a rally. We've seen a dump, which you'll see in liquidity in a moment. But this, I think, is going to be led a lot by a lot of trickery by Wall Street. So let's talk about what Wall Street is doing right now. Because one of the big things here is that we've just seen 2-year yields start to spike up here. And this is now the highest time since 2008 when it comes to Japanese 2-year yields. There's concerns over some rate hikes coming through. And this seems to be a central bank's policy across the board. Australia, where I'm from, we've got concerns now over the next move not actually being a cut in rates, but a hike. We're seeing inflation come back. The US, that's of course a question mark. Are we in stagflation? Obviously, metals like silver and gold, they're moving like stagflation. So there are serious concerns here. And of course, the Japanese yields. And what is actually happening is it's this real movement towards debt. And more importantly, everybody getting involved in looser financial conditions. Have a look here from this chart from Bloomberg. Global financial tightening indicator. Okay, interesting. It's starting to look less restrictive. Interesting. Less restrictive. You would think it's getting more restrictive if the markets are going well. But no. We're less restrictive. So that means that people are able to borrow more, looser lending, 50-year mortgages. You probably heard about those, all sorts of things. And of course, it always ends badly when they actually start to tighten buds again. But that is one of the things we're looking for. Tightening is going to bring these markets down. That has not happened at this point. Now, one of the big arguments we've had this entire month, or the month that's been in November, was that, of course, we looked towards the structure coming into it. We knew that when we had a lot of days above the 50-day moving average, once we lost it, we might pull back a little bit. We certainly did. We pulled back a little bit, but the structure is actually quite good. And what it does is sometimes it dips a little bit, then it rallies. Now, think about this coming into the end of the year, guys. We've rallied. Very nice. Nice work. Then we have a little bit of a pullback. Okay, that's pretty good. Then we rally. Okay, hit the end of the year, have a little bit of a pullback. Then we come to a really big decision. And a lot of this is going to come into seasonality. January, February, March, well known to have a serious piece of volatility in it. So next year is actually probably where the big vol's coming in, at least based on this structure. But remember, this is both for that and for the NASDAQ as well. So some excellent little bits of data there that we've kind of been playing with. Now onto the Bitcoin narrative again. We're seeing I would say like a narrative of flows from ETF side being both positive and negative. The big one we're looking at is IBIT, and IBIT got another massive outflow here on the 28th. And I think one of the things about this one is it also hit the daily 20 moving average as we saw those outflows that we now know existed. Yeah, that's what it was. It was a TP zone there. We've since wiped basically almost 6-7 grand, maybe more off Bitcoin as the time of this recording, which we'll look at soon. And it's been pushing down. Now we're back at around that average price for most ETF traders. So we know that that's why it's kind of bouncing off this level. And we're probably going to liquidate a couple of big positions. So first up, we liquidated 90K. And I say we, it's in Wall Street did it. And this is illiquidity. The problem with crypto is once we now have Wall Street involved, there are clear levels that they're going to spike out during the weekend. And we've seen this quite a few times now since this has been happening. The Wall Street weekend happens. And then, of course, what happens is lots and lots of attacking of different zones. So one of the big zones they're going to be looking at the moment is about 86.2. And 86.2 is going to liquidate quite a lot of buys. And all of a sudden, if we see a spike off that, then that's going to be quite strong towards the buy end. So we are looking for a daily 20 moving average close through. That's going to be a huge deal now for the bulls. And of course, it is a zone that we should all be very clearly looking at. Another thing is going to be structure of the markets moving forward, but that's a story for another day. So let's jump into the actual charts itself instead and have a look first up at the S&P. The big thing here was we hit the most traded zone. So a lot of you correctly in the comments, you guys are smart, I've got to say. You were saying, Tom, there's so much announcements around here. There's so much volume. It's probably going to sell off from this point. Well, I tend to agree with you. I think that we could pull back a little bit. Somewhere around that 6,700 zone could become very interesting. We'll look at the options in a moment. And clearly, we bounced off a very key area, which we built a lot of compliments on. So is this bearish yet? Not really. I think that, to really be bearish on this market, you've got to actually get underneath the 6,500 zone. We haven't done that. The structure has been very strong towards the bull end, and I think it remains strong at this point. You can see here the futures going down to around 6,800. But let's take a look at the options levels, because this is probably where the true market lies. And one of the things here is that we are seeing a lot of 6,900 calls. It's unlikely we're probably going to bounce through that. So they might be wanting to expire them worthless. We see 6,850 through the next session, which is the 2nd of December. And we keep getting this 6,700 put. Well, lo and behold, we get that level, guys, exactly where the TA technical is as well. So you can see how it all marries up. It's a beautiful thing. We love it. You love it. Everyone loves it. And 67 is now the major sup line. So that's going to be kind of where I think buyers or bidders may come back in. We're looking for action around there and see if it happens. Of course, practice risk management, do your own thing. This is not a solicitation to do anything with that particular level. But I'm just saying that options sit there. Let's have a look here at Tesla. You guys can see here that has been pretty aggressive on the upside. It broke some key levels last week, so we'll look at it soon. And it tried to get into a really positively gamma kind of situation. And of course, the key levels still remain 450 and 500, and 500 is still the major point should we continue to bull up. When it comes to NVIDIA, this one is less clear. We seem to have a lot of 160 puts, so watch the 160 level and 165s. And clearly, it's not as strong as it was. So we've seen a huge movement into Google as people start to follow Buffett and obviously get away from NVIDIA as much. And there's all sorts of stories going on about, who can afford what and what's being spent. And it just reminds me so much of that tech boom. It really does. Although I wasn't trading that one. I obviously came in after more like the 2007 kind of period. I will say I've talked to a lot of people and studied it, and it does really look like it in some ways. History is not always the same, but does rhyme kind of concept. iBit, you can clearly see here that this is not the price anymore. So we're coming back down to that 47. So 47, 50, that kind of area to worth watching. 43, ultimately a monstrous put. That's going to be, of course, a real wipe of markets if that happened. But I think we'll be watching the 47 first. So 47 on iBit, well worth watching. See how the market reacts to that zone if it does come down. And gold is going ballistic. So it's entering into positive gamma. And clearly, this is a squeeze. So we're seeing a big squeeze coming in, particularly when it comes to everything silver related. So silver took a new all-time high, and it's starting to live up to everything we've talked about, which is 1 to 2 months of sideways action, ultimately being bullish still on both those metals, and both look very attractive. So if you're in them, congrats to you. If you're not, I'm thinking there's still probably going to be another opportunity, but silver's definitely in a strange squeeze at this point. We'll talk about that in a moment. All right, well, before we jump into the charts and have a look at some of the lead indicators, I want to say a big thank you for the sponsor of today's video, which is, of course, Tiger Brokers. Now, you guys know we've worked with Tiger for a long time. They're always winning awards and listening to feedback. And one of the feedback points that they've gotten recently has been around offering even more potential when it comes to when you open an account and you're actually using their platform. So one of the things Tiger Brokers did was they introduced a little bit of a premium service for people that actually use the platform itself, and it's for members only. And of course, you get access to all sorts of things, including exclusive seminars, which are going to be awesome, weekly market insights, monthly coins, birthday gifts, priority access, all sorts of things. Why shouldn't you be rewarded for potentially using the platform and, of course, investing and trading, and also just in general, learning more things? So one of the cool features is that they always do listen to you guys. They're always accessing new stuff. And if you want to check out this along with many of the features that Tiger Brokers offers, you can do so in the links in the description down below and pinned comment. And there's a couple of little trading perks here. You can see I haven't unlocked this one yet, but hope to in the future. Guys, I hope you enjoy it. Check it out. Links in the description down below. Check out Tiger Brokers. Okay, let's jump into now what's going on with the bonds. And the big one here has been, have the bonds freaked out? Now, you will see with the Japanese 10-year and 1 year and stuff, they're starting to go up. But the main thing here is I'm not seeing a huge wipe in everything to do with corporate and corporate spreads going out. Now, we have seen recently some big tech companies, particularly Oracle, that's starting to sound the alarm on a potential bubble concern in debt markets. So remember, guys, when you're worrying about this and following it, you have to think, when will it trigger into the broader markets? When will it actually become a significant issue? And it's something you've got to keep in the back of your minds, and you've got to then look at structure and look at what they're doing, not what they're saying. So the big one here for the weekend has been the 2-year yields. They're spiking on, of course, the idea that maybe the next move will be potential hike here to deal and combat some problems that we've got in the world, inflation and reinflation and maybe stagflation. Let's see. But the Japanese 2-year obviously spiking up, and this is just showing you time and time again why it's so important to pay attention to this. But also, I think everyone's been screaming at me for a few weeks to say, Tom, it's going to crash the markets. It's kind of similar, in my opinion, at this point till last year. So remember last year around here, everyone thought it wasn't a buy the dip situation. I do think this one can be controlled. It's not that it's not an issue. It will eventually become everywhere problem, but is it happening right now? No. And I wanted to do more on it this weekend, but unfortunately this video is going to be so long if we do that. So we'll do it in the next one sub for that. The VIX got crushed. As we know, when the VIX gets crushed like this, it can bring actually volatility just around the corner. And that was a really good stat. So the VIX got crushed from 28 down to 16. That generally means a pullback will occur, and it generally means everyone was buying the dip like mad. But the pullback doesn't look to be too bad just yet. Nvidia 177, not a strong stock, guys. This has lost. Remember, it hit that fair value, which we kind of thought was around 45x forward. Well, it hit that. We kind of said, okay. I did say possibly 260, but the earnings kind of came out the way it looked. It's about 45x. So 45x, anything above there is overpriced completely, and anything below there is, of course, starting to get cheaper. This, though, is not that great structurally. So it hasn't lost its 165 level, so obviously 165, 160 is key put support, but not looking that good. 2050 cross almost about to happen as well. You can see here semiconductors versus SPY. Again, no significant breakouts of semis. So what happens with the market is we've got a broadening kind of thrust formation of other sectors, but it's not coming from that one. What about the US dollar? No bounce off the daily 20. It's always been pretty strong this way up. We did get a higher high. We are still in structural zone. So I wouldn't say there's a bid here on the US kind of dollar, but we will be looking at this kind of 99.80 zone in the future should we be able to break it. Currently, though, small time frames actually down on the dollar. Big ones are still up. What about gold? Really good rally. This thing just shows, again, why you need to practice the same level of replication. And it's actually an excellent setup from our day trading masterclass. I'll plug it here because it was really replicable. So it was an excellent buy here on gold. Silver actually took out the low. Gold didn't. Silver has since squeezed ridiculously, which you'll see in a moment. But this is a dull market. It's then spiked up. It's hit the 4,200 plus, which we suspected it would. And I think what this bodes is very, very well as we close monthlies here. Oh, that's a 2-week, not a monthly. There we go. As we close monthlies here for the most important metal, I guess you could say, in the world. And you can see here those massive spike ups across the board. And it's not just happening on gold. Gold is good, but platinum and palladium are also playing some really nice movements here as well. Big breakout there on Friday for platinum. Nice closure. Really looks strong to make new highs in terms of at least the technicals. Again, it's technical based. And you can see here as well, palladium starting to put pressure on that resistance as well. So two of the other metals doing it. Silver, though, is the story. Look at it go. Ballistic. And while I still think this will go to $75 an ounce at some point, because we've talked about that before, yeah, this was a real showstopper in terms of the gap. Take a look. Have a look at that and then where we are right now. So there's all sorts of rumors on maybe a little bit of delivery problems, bit of silver squeeze kind of thing going on. But yeah, clearly very, very strong. The markets are pushing. One of the things here is that we suspected, and it kind of goes for the stock market as well, that the kind of strength that came in with tends not to blow up straight away. The kind of strength that's coming into the stock market, yes, it's pulled down. Yes, it's rallied. Yes, it's finding weakness, but it tends not to be straight away. And I think that's very important whenever you're thinking about unwinds and where you're at in these markets. Tesla, very nice kind of double bottom base here, guys, around that 425, 420. We got the double bottom base. It doesn't really look weak on these charts. 440 will be a key level to watch technically, but as we've seen before, there are a lot of people aiming for that 500, and it's really just going to come down to what Elon says, what kind of narrative the market wants to pull out, and whether it keeps, getting that rally off there. Chinese markets don't look so good on the macro side, but look fine on the liquidity side. So we'll look for more announcements there. Price action holding up very nicely today. And the NASDAQ went above this trend line and now it's pulling back. We're looking at about 24,750, which will probably line up very well with that 6,700 US 500 if we do go back down to that level and hit it. On the crypto side, well, there we go. Look at that, wiping the lows, guys. So, yeah, that just shows you why it's so important to check out those liquidity maps. But you can see here that we've got, and we do update those daily at the moment. You can see here we've got the daily 20 moving average. We nailed it, 93.94, posted over on X, told you guys here that I was worried about that zone. Yes, it's a problem. Now, what's happening? Is the trend still down? Well, yes, it is. Have we seen liquidations? Yes, we have. Have we now seen more liquidations around this zone? Likely. People are losing their positions as we speak here, and that's a bit nasty. But this is what happens when Wall Street get into the liquidity game, and especially when they take advantage of thin liquidity over weekends. So this will be needed to look at very closely tomorrow. We'll be paying a lot of attention to this chart because I'm looking for bid or sell. Which one are we going to get? Are we going to get a bid here, or are we going to sell all the way down to the horror zone, which is down in that 75K, where a lot of people are going to be looking for the next action. Currently, trend is down, daily 20, daily 20, daily 20. That's what matters. We need to break above that to really get the bulls back involved. There's so much liquidity in here. This is where the squeeze level begins. So for now, it has been sell-off in terms of those markets. This week, we've got a bit of data coming, so I'll talk about that in the next video. But the main thing is, if you want to take advantage of our Black Friday sale, learn more about that gold replication, learn more about how to do things without really having too much bias on them, check out our day trading masterclass. I think you guys will absolutely love that. The show will make more sense too once you do it. And of course, if you want to find out more about the liquidity, check out our main advanced class. I think you'll really enjoy that, the advanced masterclass. In general, though, plenty of information coming out this week. Follow us over on X. Check out everything else we do. And of course, a massive thank you to Tiger Brokers who sponsored today's video. The thing I always like, and I always say this, if people listen to the feedback like I do from your comments down below, I read a lot of your comments. Thank you very much, guys. And there was even one this weekend that said, Tom, do this. Hey, they'll know if you know that person, and I did put it in there for you. So thank you very much for your comments. I do read a lot of them. I really appreciate it. And, a lot of the feedback's been awesome as well. It's how we make this show better. It's how I think we've got the best traders and investors in the universe, guys, in the galaxy on this channel. Thank you so much. We'll catch you later. Bye for now. See ya.